John Ulzheimer is known as one of our nation's most recognized credit experts. Having worked for 28 years in the credit industry, John has become one of the most prolific speakers about credit and the go-to authority on answers to credit-related questions. Credit Countdown with John Ulzheimer.
Hey there, this is John Ulzheimer, and today we're going to be talking about the value of adding a credit card to your credit report for insurance credit scores. So it's probably important that we talk a little bit about the use of credit reports for insurance underwriting. Now look, the primary use of a credit report, as we all know, is for lending, right? No one's going to deny that the credit report is probably most important for use in consumer lending, mortgages, student loans, credit cards, auto loans, things like that. But one of the other important uses of a credit report is the underwriting of an insurance policy. Meaning, are you going to be approved for the insurance? What kind of a premium are you going to pay for your policy? It's a lightning rod topic, right? Which means that the opinions about the use of credit for insurance underwriting is people get very upset about that. Either you kind of don't care, or it's something that really sets you off. I think the reason that it sets people off is that they don't understand the correlation. What does how you pay your bills have anything to do with whether or not you're going to be a good insurance customer? Why? They don't understand that. And respectfully, the fact that people don't understand that doesn't really matter. It's not really important. What is important is that there is a repeatedly proven correlation, statistical correlation, between the information on your credit report and what kind of an insurance customer you're going to be. So you may not be able to explain it kind of in common sense terms. Oh, this is why it's important. But the math has been proven repeatedly that the two are correlated and very strong, by the way. So the quality of your credit report is definitely relevant to what kind of an insurance customer you're going to be. All right, so the difference between insurance scores and credit scores, we got to talk about this before we talk about adding the credit card part. The credit score that's used for lending is not the same kind of credit score that's used for insurance. Even though they're commonly referred to as just credit scores, they definitely are not the same thing. The scores that are used, so let's take FICO scores used for lending, for example, right? Billions of times a year these scores are used for lending. The design objective of a FICO credit score is to predict the likelihood of somebody going delinquent on a loan or some form of credit in the next 24 months. Not that they're going to be a good insurance customer. There are, however, a different variety of score called an insurance credit score. People tend to just not include the word insurance, and so that's why I think the two score types get kind of commingled like that. An insurance credit score is built specifically for insurance companies, and they predict the likelihood of one of two things. Number one, that you're either going to file a claim, right? Or number two, that you're not going to be a profitable insurance customer. And that's called a loss ratio model. So it compares the amount that you're likely going to cost an insurance company relative to the amount that the insurance company is going to make from approving your policy application. Of course, insurance companies don't make money unless they bring in more from you than they pay out in claims. And so that's called loss ratio. So how does the credit card help? Well, what is absolutely true and consistent across credit scores and insurance credit scores is that the information on your credit report is predictive and important, which means that if you have positive information on a credit report, you're likely going to score very well in not only credit scores, but also insurance credit scores. That includes how you manage your credit card accounts. So if you have a credit report that's got a lot of credit cards, whether you're the primary card holder or the authorized user, if it's on your credit report, then it matters. If you're paying it on time, if you have a low balance relative to the limit, if you don't have a bunch of credit cards with balances spread out all over the place, that generally means good things for you, not only from a credit scoring perspective, but an insurance scoring perspective. So that's why it is, in fact, a good idea to have positive credit cards on your credit report, not only because of the credit aspect of it, but also for the insurance aspect of it. So the next time you apply for an insurance policy, whether it's homeowners insurance or renters or something like that, there's a possibility that their credit report is going to be pulled as part of the underwriting process. Your insurance credit scores are going to be calculated, and they are going to matter. So yes, if you're going to add a credit card, you are going to get tangential value in the insurance context as well as in the lending context. So go for it. Thanks a lot for watching. Have a great rest of your day. We'll talk again soon.
For more videos and credit tips from John Ulzheimer, go to www.tradelinesupply.com.